In this week's video, we'll review the latest charts and data to help us answer the question, are cracks appearing in the long-term bullish dam? We'll be moving quickly, so feel free to use the pause button on your video player. We'll start by examining charts of the S&P 500, including this monthly chart dating back to 2009 with the 10-month moving average in blue and the 40-month moving average in red. You can see during the bear market in 2022, the 10-month moving average came down near an upward sloping 40-month moving average and held. This is a constructive look, which shares some similar characteristics to this look here in late 2016, 2017, and if you know your market history, you know the stock market rallied into Q1 of 2018. Now let's switch over to a monthly cloud chart. This is 1950 on the left side of your screen, early 1970s on the right side of your screen. You can see the constructive turn here in 1954, 1958, 1963, and 1967. Those turns look significantly different from these bearish turns in February of 2001 and July of 2008. And that's relevant because following this point, the S&P 500 lost 37% in one case, an additional 37%, and in the second case, almost 47%. So how does the same chart look today? On October 17th, 2024, the answer is constructive. And on the S&P 500's weekly chart, we've got MACD here, very similar indicator, PPO on the bottom of your screen. You can see weekly momentum is trying to make a positive turn. During Thursday's session on MACD, we had black above red. This looks like a resumption of the uptrend since this cross is occurring above the zero line. Similar message here. This is a different version of the S&P 500's weekly chart. We've got stochastic RSI on the bottom of your screen. You can see this is calendar year 2022 here. Not a good look, but typically when you go from the bottom of the range on the oscillator to the top of the range, that too indicates improving momentum, and typically good things happen. You can see during Thursday's session, we have moved from the bottom of the range on the oscillator. We are trying to recapture the top of the range. You can also see weekly RSI down here below 30 during the COVID crash in 2020. Low readings again during the bear market in 2022. That's not what we've seen or what we have in mid-October of 2024. The daily chart of the S&P 500 also has a constructive look in mid-October. We're looking at the 50-day moving average in blue, top of the stack. The slowest moving average, the 200-day moving average in orange, is on the bottom of the stack. Now let's flip over to the weekly chart of the broad NASDAQ composite. You can see all of this consolidation up here in mid-October of 2024 occurring well above an upward sloping 200-week moving average in red. We also have a positive turn-up look in momentum. That's an attempt to make a positive turn during the session on October 17th. This is a weekly cloud chart for the NASDAQ composite. If we look at the correction in the second half of the year in 2023, you can see blue comes down near red here. This is the constructive. The trend is trying to turn back up look late in 2023. Moral of the story, when blue and red are close together, you've got somewhat of an indecisive trend look, and as blue is moving away from red, this is similar to this look in here, and similar to this look in here in Q1 of 2023, and in both cases, good things happen walking forward. It's good news for the bull market, good news for the tech sector in general, and good news for the AI story that SMH, the semiconductor ETF on the daily cloud, has a more constructive look in mid-October than at any time after this peak here in July of 2024. During the trading session on October 17th, 2024, checking all of the bullish boxes. Everything that we just said about the chart of SMH also applies to the technology sector ETF, the technology sector of the S&P 500, ticker symbol XLK. And the same can be said for the improvement on the daily cloud for SCHG US growth stocks, large cap growth stocks. You may hear that the NASDAQ has gotten way ahead of itself, but that doesn't really match the facts. The NASDAQ relative to the NYSE composite ratio peaked here in late 2021. We're still below this point. So this daily chart with the 200-day moving average in red and the 50-day moving average in blue helps us keep an open mind about market leadership. We don't want to make any assumptions that what we've experienced in the rearview mirror is what we're going to experience in the coming days, weeks, and months. Similar situation here. This is a weekly chart with the 30-week, the 40-week, and the 50-week moving averages. We use this in 2023 in Q4 to help us identify that turn in tech relative to the S&P 500. Momentum was also turning up. Chart on your screen was covered in November of 2023 and is dated November 9th. If we look at a similar chart today, it also tells us to keep an open mind about market leadership, especially in the short to intermediate term. If we drew a trend line from this point to this point and extended it out here, that's step one of a trend change. Any one of these lows in here could be considered step two. These are higher lows in here relative to the low back here. And this would be step three. We eventually exceeded this high and this high. Having said all that, to feel more confident about leadership in the 2024 market, we need to see this ratio move back into this area here. As we've mentioned in previous videos, we don't want to get too hung up or distracted on the relative charts or about the question of leadership. Because if we look at the NASDAQ in isolation, everything looks fine. We've got the same 30, 40, and 50-week moving averages up here. All of this consolidation, when we look at the NASDAQ composite in isolation, occurring well above a positive and bullish sloping 200-week moving average in red. Everything that we just said about the chart of the NASDAQ composite also applies to the S&P 500. As we've noted numerous times in recent videos, we are in a bull market, and typically it pays to be patient in a bull market. Very similar constructive look in XLK, the tech sector ETF, the tech sector for the S&P 500. Since this peak here in July of 2024, it has not been leading, but in isolation, this chart looks fine, telling us not to overthink things or to get too cute. As we covered in last week's video, if we step out to a monthly time frame and look at the primary trends, tech is still unquestionably the long-term leader relative to all of the other S&P 500 sectors. Similar situation when we look at the NASDAQ 100 in isolation, the True Strength Index on the weekly chart down here trying to turn back up in a constructive manner, similar to late October, early November 2023 after this corrective period was over in 2023. All of this consolidation here looking healthy and occurring above an upward sloping 30-week, 40-week, and 50-week moving averages. If you pause your video player here and compare the present day to the negative rollover look in the year 2000 as the dot-com bubble was bursting, and or the rollover look in late 2007, early 2008, take those negative looks, contrast them with the positive turning up look in 2004, the positive turning up look in 2009, it's pretty easy to make the case that the right side of your screen on October 17, 2024 aligns with the term constructive. This speaks to long-term market probabilities. After this cross, the market went up for a long period of time. And we're also seeing improvement on shorter-term time frames. This is the 8-day moving average all the way out to the 50-day moving average in gold. The present day here looks significantly better than this mess back here in July, August, and early September. All of this consolidation occurring above this upward sloping trend line that dates back to that low in October of 2023. If we switch over to the more narrow NASDAQ 100, we also have that constructive trend trying to turn back up look on the chart of the weekly cloud. Now we'll be thinking broadly by looking at monthly cloud charts in the 1973-74 bear market, the dot-com bust bear market, and the financial crisis bear market. The chart shows you the negative rollover look in each case in the early stages after the major low. So in the present day, do we have something that looks like this, or this? The answer is no. If we look at the same monthly cloud chart for the NYSE composite, once again, it aligns with the term constructive. Compare and contrast the present day look with the negative looks on the previous charts and the positive looks shown on your screen in 1991, 1995, 2012, and 2020 after the COVID low. Like the S&P 500 on our shorter term time frame, we're looking at the 50-day moving average in blue all the way out to the 250-day moving average in silver. The NYSE composite has a constructive look with a full bore bullish look with the fastest moving average on top, the slowest moving average on the bottom of the moving average stack, price above all the moving averages, and the slopes of all of the moving averages are up. That looks significantly different relative to this concerning rollover look here in Q1 of 2022. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. This is a bullish breakout that occurred earlier in 2024, and we still have a very constructive, strong trend look when we look at the S&P 1500 index, broader than the S&P 500. Looking at the 30, 40, and 50-week moving averages, we have a full-bore bullish look. Does that mean that this chart says leadership is shifting in a big way? If we look at the same 1500 index relative to the S&P 500 and put a 200-week moving average on the chart, the answer to that question is no. 1500 still lagging the S&P 500, and the same can be said if we look at the 1500 relative to XLK and put a 200-week moving average on the chart. Now let's look at the Dow Jones Industrial Average and the broader Dow Jones Composite, similar to the chart of the S&P 500 and similar to the chart of the NYSE Composite. This is a very constructive look. Could be taken right out of a technical analysis textbook. And if we compare and contrast the present day look of this chart, the constructive and improving look, when we look in the rear view mirror, it doesn't look anything like the failed rally attempt here in 2008 that eventually led to extremely painful outcomes. Chart shown on your screen has the exact same moving averages as the October 17th chart shown on your screen. This looks a lot better than this. And if we look at a monthly chart with a 40-month moving average, the present day, this looks a lot better than this during the dot-com bust bear market and a lot better than this during the financial crisis bear market. We also have a constructive weekly cloud and a very constructive look on the daily chart of the Dow Jones Industrial Average. Moving averages on the smaller chart range from the 8-day all the way out to the 250-day moving average in black. How do market participants feel about small and mid-cap stocks? The trend in the S&P 600 small cap index in isolation is constructive, checking all of the bullish boxes on the weekly cloud. However, we still don't have significant improvement or really any improvement on the relative trend. This is the S&P 600 small cap index relative to the S&P 500 large cap index. We've got the 200-day moving average sloping down, the 50-day moving average in blue below the 200-day, and for the most part, prices below both moving averages, and the slopes are down. If the look on the right side of the screen morphs into something more like this period in here in late 2020, we would be drawing different conclusions. That may happen very, very soon, but it hasn't happened yet. Similar situation when we look at the S&P 400 mid-cap index on a weekly time frame. This is a very constructive chart. But we still have a full-bore bearish look on the same S&P 400 mid-cap relative to the S&P 500 large-cap index. As we've said for weeks, what does it say about the general market when one of your laggards like the S&P 400 looks this good in isolation? It aligns with that concept that we're in a bull market and we don't want to get too cute. How about gold? Clients that have been with us for some time, most of you do own a relatively small stake in gold because this is a fantastic looking chart with a breakout from a cup and handle pattern. However, if we look at the exact same chart, upper left-hand corner of your screen, but this time take gold and divide it by the S&P 500, this looks significantly different from a trend perspective relative to this. Once again, a laggard has an extremely constructive long-term look. How about market breadth? If you pause your video player, this is the NYSE Advanced Decline Volume line. Constructive look after the major low that occurred in October of 2002. This is 2003. Good things happen for a long period of time. Constructive look after the major low in March of 2009. Constructive look here after the low that occurs in February of 2016. And a similar turning up and constructive look on October 17th, 2024. Now we're looking at the NYSE Advanced Decline Issue line. Advancing issues minus declining issues. Constructive look, similar look in 2024. It's the NASDAQ Technical Index. Description, upper right-hand corner of your screen. Probably fair to say 2024 looks a lot more like 2016 and 2013 relative to this extremely concerning look in 2007, 2008, or this concerning look in 2011, 2015, 2018, and 2020. Like every chart that we've covered thus far, this chart simply speaks to the probability of good things happening relative to the probability of bad things happening. Technical analysis is about subtle shifts in mid-October of 2024. Probably fair to say this is a subtle shift relative to the look of this indicator, a breadth indicator dating all the way back to October of 2023. S&P 500 Advanced Decline Volume line. Present day look in 2024 is similar to this constructive look in late 2012, early 2013, and similar to this constructive look near the 2016 presidential election. S&P 500 down here, S&P 500 down here, lower portion of your screen. Since we're using a weight of the evidence approach, common sense tells us it's very difficult to interpret this in a negative manner when the Dow Jones Corporate Bond Index recaptures the 200-week moving average in red. You can make an argument this point here is similar to this constructive look in 2009 and similar to this constructive look in 2003. Previous chart was a weekly chart, the exact same message when we look at a daily chart with the 200-day moving average. Constructive look here in 2009 after the major low that occurred in March of 2009. Similar consolidating look in the present day above a now upward sloping 200-day moving average in red. This chart was helpful in late 2022, early 2023. We covered it numerous times in past videos. Constructive look here on the Dow Jones Growth Index with the weekly chart exhibiting positive momentum characteristics. You can make an argument this look here is similar to the look after the major low in 2009 and in this window here in early 2017. Technical analysis about subtle shifts. We covered this chart several weeks ago, and it still looks different and constructive. To summarize, all of the charts that we've covered in this week's video align with, rather than contradict, the thesis that we're in a secular bull market primarily driven by favorable demographics. And everything on this chart aligns with the CCM secular volatility model scores on your screen, in the recent constructive drop in the XLP-SPY ratio shown on the weekly cloud. As always, it's extremely important that we don't become complacent. But at the same time, we don't want to get too cute, overtrading our accounts, or being overly concerned about being in the market leaders every single day. We don't want to overthink our way into overtrading. It's extremely important that we keep an open mind about a wide range of outcomes, from extremely bullish to cases that are more bearish than you could ever imagine. Which is another way of saying, we all know the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.